Hi, I'm Roger Montgomery from Montgomery Investment Management and welcome to this week's Video Insight. Now, notwithstanding the last 2 days of selling, markets have been relatively sanguine about COVID-19, with the S&P 500 hitting record highs just last week. The contrast between the market and the real world has, up until this week, been glaring. Last week, here at the office, we discussed the improbability of the virus being contained. With only a small group of countries banning inbound flights from China and infection occurring while the carrier is asymptomatic, the chances of the virus escaping and spreading to pandemic level is about 100%. And here we are today, with the death toll from the coronavirus now more than 2,700 worldwide and more than 80,000 global cases. Additionally, the Mayor of San Francisco has today declared a state of emergency, hotels are in lockdown in Italy and Austria, and the virus is spreading in Iran, Croatia and Switzerland. Europe has also vowed to keep borders open. The Chinese authorities' attempts to corral the virus to an area home to more than 320 million people and an area responsible for a quarter of China's output are already having a material impact on economic activity there. And the speed with which factories are permitted to reopen will ultimately determine the length of time China suffers a serious deterioration in economic activity. And China, of course, plays a critical role in global supply chains. China's manufactured components are found in goods globally, and Chinese intermediate goods represent more than 20% of imports for many countries, including Japan, Australia, the United States, Korea and Hong Kong. The lockdown in China also removes an important source of demand. And now, as the virus spreads across the globe, demand will drop further. And this is the key issue. It's one thing to consider the impact on the economy from individual outbreaks being contained. It's quite another thing to contemplate what transpires when citizens start modifying their behaviour, such as cancelling travel and deferring consumption out of fear for their health. The extreme but unknowable probabilities, combined with the most recent and relatively benign SARS coronavirus experience, has had stock market participants preferring to believe a substantial stimulatory response from China would kickstart a V-shaped recovery. The stock market, however, has not been alert to the real world. While there are obvious consequences from travel bans for the travel and education sectors, the damage is already being felt beyond those clearly definable industries. Retailers are now reporting difficulty in stocking shelves, and many manufacturers are beginning to run low on components essential to their manufacturing processes. While the stock market has recently been hitting highs, bond yields have been hitting new lows. Optimism in the stock market is not being reflected in the bond market, where a flattening yield curve suggests the global economy is going to struggle for a period much longer than equity investors are willing to admit. The stock market appears to be ignoring the fat tail risks associated with companies' cash flows being impacted to such an adverse extent that their debt may become challenging to service. And remember, global corporate debt is at an all-time high. There are a number of reasons the stock market is being optimistic, but none of them really seem logical. The first is that it's betting on central banks continuing to print money to rescue the economy. This may indeed be the case. The second reason is that trading algorithms are unable to account for fat tail risks such as COVID-19, and being unable to anticipate it, they default to doing nothing at all. Exchange traded funds and index funds remain fully invested, blind to the risks. The final reason for the market shrugging off the increasingly likely consequences of coronavirus is that it is normal to do so. Equity markets have initially responded equally benignly to past threats, going all the way back to the rise of the Third Reich. This is because taking out insurance to cover extreme risks is prohibitively expensive. The consequence of this is an asymmetric type response, where markets appear to simply muddle along for a while until they fall off suddenly, a great big cliff. For investors with Montgomery, we're delighted that the Montgomery Fund and the Montgomery Private Fund have about a quarter of their portfolios in cash and equivalents, including a holding in Helios, which is now the subject of a takeover. The Montgomery Small Companies Fund currently holds between 12 and 15% cash. We're also delighted to have concluded the takeover of our holding in QMS. If you have questions about investing with Montgomery, or more generally want to know our thoughts on coronavirus or about investing in funds that have the flexibility of preserving capital by holding cash, please contact David Buckland or Toby Roberts here on 02 8046 5000. That's 02 8046 5000. And I look forward to talking to you again and updating you on coronavirus very soon.